Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk, the weekly review on Friday, 13th of February, 2026. This is where we break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead. We'll try and give you a heads up on what you should be looking out for. This episode, I'm joined by our regular contributor and market expert, Sam Cutler, portfolio manager at 333 Capital. Hey, Sam, how you doing?
Hey, I'm pretty good, man. Yourself?
Very well, thank you, very well. Just before we get into it, quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any gains or losses you make with your investments. I'll say this every single time, and yeah, I still can't remember. We're not responsible for any losses or gains that may result from following the content on this channel. So with that out of the way, hello, Sam, and we'll get straight onto it with the week that was, because there's a fair amount of data. It was a US heavy, data heavy week this week, specifically because we had the partial government shutdown. We have a partial government shutdown, and data was forced into this week that we would have typically had last week. I'm talking mainly about non-farm payroll, but we had non-farm payroll, retail sales, non-farm payroll, and today we had CPI, because we're recording this on Friday, as I said, the 13th of Feb. We'll start with the CPI because it's the closest to hand, and we'll look at the labour data. So we saw a softness in the US inflation read today. A quick look at it, 2.5 for that core year over year, from 2.5. I think we were looking for 2.5 anyway for that, so that was roughly in line from 2.6. That's down a tenth. On the headline number, if I can get that up, we saw 2.4 versus 2.5 predicted, I think, and 2.7 last as well. So, yeah, some softness in the data, maybe not entirely unexpected, really, and may portend to further cuts. I think the market's now priced in that 50% probability of a third Fed rate cut this year. Sam, what sticks out for you on today's CPI read?
Yeah, I mean, there's not a ton to cover on it. I didn't really expect a whole lot, especially because it's the January print. So it was nice to see actually the numbers come in, we'll call it relatively in line to slightly lower, because you typically tend to see a little upside in January just because of price resets at the beginning of the year. I was a little concerned just because of the reactions we've seen, this week, like you said, with the data being pushed this week. We've seen some pretty, large moves in rates. And I want to say large moves, but I mean, let's be honest, the equity moves are not that large, but we're still getting decent moves in equities and decent moves in the rate space this week. So I was a little, I don't want to say on edge, but a little more primed coming into this CPI number, just in case there was kind of, a larger upside or downside miss. I'd expect markets to react a little harsher just because of the larger moves we've seen this week. But I'm really starting to come to the idea that I think it's safe to say the odds of the right tail risk in inflation is falling off. We had unrounded core at 0.295. So, yes, it's the largest gaining core since August, but there's some interesting drivers in there. And it's the same thing with that super core metric. Like the super core metric, I think, was the highest since January 2025. And I think that was what, 59 bips or something like that on the super core.
0.53 from 0.2 something. So there was a fair, uptick.
Yeah.
Relatively speaking.
Yeah. So, that I think started to point some people to, okay, maybe there's a little bit of risk in there. But when you break down the number, right, you see airfares up 6.5%, right? So that's a big driver of that super core component. So it was really an outlier print, because I think that picked up from like 0.3% from the month prior, I think it was. So you have to look at that. Then you also have to take note that, the Fed's preferred gauge of inflation, the PCE, it takes airfares from the PPI report, not the CPI report.
Got you. It's important to
So,
understand that. Yeah.
yeah, I mean, all in all, I think it was I think it was a suitable reading, and I think the main takeaway from this is, I used to, for the past few months, 6 months or so, I was very cautious on inflation, thinking, okay, there's a chance, with all these tariffs that it could kind of resurge, make inflation sticky. We're seeing a pretty decent trend of disinflation. And I'm starting to be a little more convinced that, like I just said at the beginning of this, that right tail risk is kind of falling off on this front. So it makes sense to see the market start pricing in more cuts. And,
Mm.
if the labor market stays weak, I'll say, because I don't agree that it's stabilizing. I mean, I think you're definitely in the camp for potential 75 basis points to potentially even 100 basis points of cuts this year if the labor market, deteriorates as I think it will.
It'd be interesting to see if that makes Trump happy. If that's, I mean, where a token gesture will be enough, but because Walsh is obviously under a bit of pressure, the incoming Fed chair, to if he's sanctioned by the Capitol Hill, which I imagine it would be. But again, that's there are some question marks around that. But then what was I don't know what Trump's thinking was in terms of how much of a how much further easing there was to be. But I mean, we heard from I think it was Beth Hammack earlier this week, and she was quite happy to see rates stay as they were for a period of time and let things play out a little bit more. So there's still going to be a bit of division in the board, the governing board, really as to where we go on rates. And I think you'll find the minutes we'll come into the week ahead, but the Fed minutes next week may be a bit revealing as to those in favour and those against further easing in the near term. So we'll wait and see on that one.
Yeah, and I mean,
Um,
you also have to think we're probably somewhere like everyone thinks we're near, kind of that neutral rate. What the
mm,
overnight rate right now is what 3.63, right? So I think if you do have this right tail of inflation coming on, coming off, I should say, I think you're definitely 100% going to get that, kind of 50 bits of cuts. And I think to get it, I'm just going to be simple here, and to get it under that 3% handle, I think that's where the stabilization in the labor market comes from. So I think right now there is, and I don't want to get political on this front, but I think there's a little bit of split in perceptions in the Fed right now, just because of the stuff that Trump's doing. Like, he's causing problems for the Fed. So I know the Fed, and like Jerome Powell says, they're always going to do what's right for the economy and that. But I still think, maybe subconsciously, there's some underlying tones in there that some want to kind of go against the president, or not do exactly what he wants. And he wants rate cuts. And I
mm,
think, the main reason he wants rate cuts is, just for the homeowners market. He wants those 10-year yields lower. He wants to make housing more affordable to the median buyer with,
mm.
midterms coming up. It's a very tough landscape to navigate, I think, on that front. And if you look at the recent home data we got this week, it was terrible
Mm.
in the US. It was absolutely terrible.
I think we got existing home sales this week, didn't we?
Yeah. Yeah, and it was
Um,
pretty bad.
yeah, I mean, there was a Fed study I think that suggested 90% of the tariff, 90% of the costs were borne by the US household or the US consumer from Trump's tariff. Well, from the tariffs that he put on these different trading nations. So there is there may be a bit of kickback on that in the midterms, maybe.
Yeah, and I mean, that's a big thing too, to see what happens with, the Supreme Court ruling on the tariffs, and also Lisa, the Fed Cook case too.
Mm.
So
Yeah, all plays into this whole big narrative, I guess. Um, we know that the Fed have been more focused on the labour market than on prices right now. We saw non-farm payroll come out. That was a superb number. It was 130,000 from I think 68,000 expected here. Unemployment rate was at 4.3%. We saw firmish wages. I did think they weren't going anywhere too far. How did you see that?
yeah, so I mean, I'll take a shot at this employment report, because I think there was some interesting metrics here that I think a lot of people, are gonna miss. Because,
Mm,
like, we always say, these headline numbers. I mean, it's just so hard to take them for what they are. So yeah, the 130K gain. Okay, great. That looks huge, right? But I think it's misleading for A few reasons, and it's pretty much because we saw single sector resilience. Like almost that entire gain came from just one area, which was the health and social services, which I think they
Mm.
added 123,000 jobs there.
Oh, okay.
Right. So if you strip that out, and I saw an interesting chart. I didn't actually know this, but it's now been 18 consecutive months of adding jobs in healthcare and social, totaling about 1.6 million jobs. Now, I think this chart was from the Financial Times, and there was another part of it that showed like all the other segments were running, I think, negative. I think that's a little false because you had all those government layoffs as well. So
Yeah.
that skews the data quite a bit. So you can't really take that chart for what it is. But if you go through the data, it's still pretty apparent that most other sectors are slowing drastically, and that the labor market, I don't want to say is grinding to a halt, but it's slowing more drastically than I think a lot of people realize. And we did see some large downward revisions in those, but I think everyone was mostly knew those were coming through. But a few of the key points I think a lot of folks will have missed, which is one of the main reasons right now I'm super suspicious on that unemployment rate, is I think we're going to continue to see weakness and the unemployment rate climb higher this year. And one of the reasons is the BLS is still using population estimates from before Inauguration Day, right? So it's not accounting for any of like the subsequent tightening we've seen in immigration policy. So you're
Right.
likely getting an overestimation of people in the workforce, right? And if you go back to even just this one print, the weather disruptions, right? We kind of saw that already play into the initial jobless claims,
Mm.
and for this NFP, it led to even a lower response rate than usual. So probably again, another tick in the column for making the data a little less reliable than usual. So
Mm.
then you look at also like if you get into the little statistical side of things, right? If you get into the confidence band, the household survey is so wide, it's plus or minus like 400,000. So, the drop in unemployment might actually, you know, not really be a drop if you look at it through, a purely statistical lens. But I think the main points here is that there's still, under the hood weakness. The market's initial, positive reaction on the air quotes beat kind of ignored the reality that the hiring being shown is extremely narrow and concentrated in those healthcare services, which is pretty much outpatient and counseling. Again, the revisions show everything's much weaker than originally reported. Everybody knew this. So I think next month we could see some issues because we're actually going to get the updated population counts. Normally they're supposed to come in January, but I think because of this government shutdown, they've been pushed out a month. So we're going to get them in March for the February report. And I
Okay.
think I think you're going to strip out about 750,000 here because if you
Well,
look at the Census Bureau, right?
mm.
The BLS is actually overshooting it by about, I think, like 1.2 million people ages 16 and over. So if you kind of grasp that current employment to population ratio, I think it's just a smidge under 60%. So, you do that 60% on that, 1.25 million people, let's say, you get right around a drop of 750K. So I think the unemployment rate here could just kind of be a statistical suppression. And, I personally still think for these reasons and for lots of other reasons that the labor market isn't really stabilizing. And I
Mm.
think there's a lot more weakness under the hood. And, I kind of have some bets going that we're going to see unemployment climb higher throughout the year.
And do you think AI will play any part in that, or do you think that's still a developing story?
I think it's a developing story, but I do 100% to think that the productivity drive in there is leading to kind of that growth in GDP. But the problem then when you get the productivity drive in GDP, you kind of need employment to really push to keep those gains, or else you're going to get a fall.
Mm. Okay. But there was a note here from Bank of America. They said higher productivity growth means higher, not lower, real neutral rates, which would be an interesting one.
Yeah,
Um,
that would be interesting. But I think again that factors into the jobs. Sorry, excuse me. I think that factors into the jobs front, right? Because like I said, we're not seeing mass layoffs, but we're not seeing much hiring. So again, I mean, you could dive so many levels here with, you know, birth rates and
yeah.
population aging and such. But I think then you're seeing, especially in, how do I want to phrase this? If you're using AI to replace jobs, right? Obviously, it's still a very new thing that's coming, but it
Mm,
would take the place of a lot of those, I don't want to say entry level, but kind of entry level jobs out of college. So I think it's kind of important when you're also looking at the unemployment rate to also break it down into those age categories and see what's driving,
yeah, that makes sense. That makes a bit of sense. Okay. Um, so we covered that. Obviously, we had retail sales as well, flatlined in December. Kind of backward looking data, really, but doesn't augur well for consumption in at the start of the year, at the start of this year, as we play catch up with the data, I guess, on that front. Um, but with falling inflation, potentially, there may be some sort of rebound in retail sales. Again, that's also dependent on the labour market and how fast that falls away. So again, it's uncorrelated, I think, at the moment in terms of what we're seeing, because we've got, as I said, it was December retail sales data we had this week. I think because of um, the government shutdown or so forth. I'm pretty sure about that. But either way, that maybe the resilience of the US consumer is starting to be tested a bit more as we get into the new year. Um, I want to move on to the UK because, again, I know you're on the other side of the water, but there's been a hell of a lot of news this side in the UK. From about the PM losing his job, the Prime Minister losing his job because of his connections with a now disgraced former MP and Lord Mandelson, and his ties with Jeffrey. Everyone's getting touched by Jeffrey Epstein. Well, so excuse the pun, by Jeffrey Epstein and what happened, the scandal around him. Um, how much do you pay attention to the UK scene, and how does it affect your how much influence does it have in your portfolio?
Yeah, I mean, it doesn't have a ton of influence, but I do a lot of, relative value rates trading. So I do trade a lot of the UK on that front. And like I was telling you before the show, my messaging on Bloomberg has just been
Mm,
blowing up with headlines on. I had to mute some of them because that's how annoyed I was getting. I'll be honest, I don't follow the political scene like super, super in depth there. Like I understand
I don't
certain
blame you.
parts of it, but I'm more into, or call it the data front, like the UK data, right? Which I've
Mhm.
been expecting to be, extremely weak. And I think what we had to grow at,
Point 1.
0.1% in Q4, which was, just under I think it was estimated at 0.2. We're still seeing manufacturing and factory output really struggle. Service sector output did rise, but I mean, the previous month's data was revised lower on that. So, I think the trend is still pretty tepid there. And I'm very negative on the UK. I just have this feeling. I think they're going to cut a lot more that's already priced in. I think the economy's still running much weaker than what most people think, and I think the political pressures, add a little bit of uncertainty to that front as well.
Yeah, definitely. I mean, we had a rate decision last week, and they kept rates on hold, but the signals were that there's an impending rate cut, and it could come as early as March, which is the next meeting. Yeah,
Yeah, I mean, I think for sure they're cutting in March. I think for sure they're cutting in March, and I think
mm,
you got the odds to definitely see another one or two cuts this year there as well.
yeah. I mean, the monthly read was also a growth of 0.1%, which was also in line with expectations. But ultimately, if we're looking at 0.1% growth rate per quarter, we're underperforming as a as a nation for sure. Right, let's move on to the week ahead, really, because there's plenty to look at. We headline it with the FOMC Jan meeting minutes. We've kind of alluded to the fact that there's potentially still a split within the uh, the committee or the board as to further cuts. Um, will you be looking at this in much detail just to see how granular or what their thinking is really at the bank?
For the minutes there, the FOMC?
Yes. Super.
Yeah, I mean, it'll be interesting. I find, to me, the minutes, I never really dive too deep into them because I look at them as kind of stale data, especially after, we kind of get Powell's press conference. I don't
Mm,
think they have too big of a factor, but I think it just helps you see, okay, how's the committee stand? Is there much more division than, how Powell kind of played it out in the presser?
sure. Again, Bank of America here says forward-looking indicators are positive. So, in addition to the signs of breadth in the recent data, we see more reasons to be positive about the outlook for broader investment in the coming quarters. They say early signs of broadening out in activity. They're looking at the likes of the ISM index surprised to the upside, topping 50 for the first time since Jan, driven by a surge in new orders, they said. So again, looking at some of this data here, they're fairly bright on early prospects for this year, which may be that dichotomy between some in the Fed looking maybe further into the year and those that think it's right to keep rates as it is for now. Um,
Well, and I think on that front too, you still have to think about what's happening in, the first quarter of this year. I mean, it feels like we're a year into the year already, but it's
mm,
only February 13th, right? And we still have that one big beautiful bill stimulus. You have consumer tax refunds. So there is still a decent amount of stimulus in the first quarter of this year, right? So
mm,
I still, it's still in my mind that you can see data surprise to the upside, in Q1 for sure, for sure. So I think, like we've seen, data is still going to optically beat. If you look at some of those economic indexes, I think Citi has one, Bloomberg has one. You actually are seeing kind of the growth front start to roll over a little bit. Like it started to peak and start to come down a little bit. So I think the big question here is Q1's going to be more or less okay, right? Like
right.
you get 1-2% drops in the market. That's nothing to say. Oh God, things are going terrible, like everyone does, right? Like the
Mm,
market pulls back 1.5%. People act like it's the end of the world now. It's not that big of a thing, right? But I think the question is when we transition out of the first quarter, into the late second quarter, second half, to even possibly the second half of the year.
okay.
Are we going to get this growth scare reversal because that initial bit of stimulus wears off? And like I
Mm,
said originally, I think the labor market continues to weaken. Now, is that going to lead to kind of a second half of the year growth scare? I think there's a big possibility of that actually happening.
okay. Okay. Fair enough. Um, we look at further. So we've got GDP growth data out. I think 2.2% is where we're looking at for this prelim US Q4 GDP growth. Yes, it's backward looking. Obviously, we've got the conflation of having the government shut down amongst all this as well. But analysts still look for maybe decent consumer spend. Again, although I've read reports that some think it's going to be dampened down by the government shutdown, others say it'll remain resilient in the near term. HSBC says that GDP growth slowed to an annualized rate of 2. They got 2.8% quarter on quarter,
Yeah, I think
impacted.
2.8 is the survey.
Yeah, 2.8 impacted by a 43-day federal government shutdown that damped consumer spending. I want to take a look at the Bank of America because they were looking, yeah, they're looking for a solid they put it as solid 2.2% print, supported by healthy consumer and December personal income outlays. There's a bit of a spread there, but like you say, the consensus is probably nearer the higher twos really on that
Yeah,
front.
I think it might come in a little bit lower than that. I kind of, if I had to put some money on it, I'd be in the lower twos for sure.
Yeah, fair enough. So that's we've got that out next week. Also, going back to the UK, we've got inflation data. We've got average earnings. You've got labour data coming for the UK as well as inflation. On the CPI front, it's projected to ease to 3% for CPI. But some were looking for a bigger drop, and I think over the next coming months, people are looking for that disinflation pace maybe to pick up a bit due to lower petrol prices and favourable base effects. Services, which is always a key component of the data, that remains fairly steady and solid there. And banks say that this indicates persistent inflationary pressures in the economy. Again, we saw last week's split was a narrow one to keep rates on hold 5 to 4. Bit surprising how tight it was. People thought there might have been a large consensus to keep rates on hold, but it shows the battle and the tension within the MPC and Monetary Policy Committee when it comes to rates. And as we've talked about here, there is a growing expectation that we'll get a cut at the next meeting. UK labour data as well, labour market data has been fairly moribund, but maybe a bit of slack in the UK picture as well that may encourage some on the rate side as well. Elsewhere, we've got German ZEW survey. It's not looked at a great deal. We got IFO the week after, but in combination, we're looking for a slight pickup in the sentiment around German industry and corporates because it's been in the doldrums, and we do have this stimulus package coming in that starts this year and will build. So I think people are starting to be a bit more positive about the German economy and therefore the Eurozone economy as a whole. But I don't think it's going to push inflation in any meaningful way to the upside at the moment, according to experts. And then we've got Canada CPI. HSBC said for January, expected to show a decline of 0.2% on the month with annual inflation at 2.4. Any views on Canada inflation?
Yeah, I mean, I think it's pretty much anchored as it's been. There's not too much going on there. The only thing that caught my attention this week on Canada was the U.S. House there. They voted to eliminate certain tariffs against Canada, and that kind of got some of the pricing moving in Canada a little bit. You saw, decent pullback in yields, and maybe a little more cuts possibly being priced into Canada here. But I think it kind of seems more like a political stunt, though, because I think even then there's still a large chance the president, if I'm not mistaken, I believe he can still veto it.
Yeah.
So I think I think the only thing you can actually take from this, and this is just coming to my mind right now, but I think it shows that Trump is kind of losing a little bit of his authority, and I think that's accelerating. So I think that also to what we were just saying about SCOTUS tariffs and the Fed Cook case, that those should actually kind of come to mind, because if those don't go in his favor, and like his loss of authority really is kind of accelerating here. So sorry, that's just like off topic. It just popped into my head.
No, but I mean,
I think that's something that's kind of could be important to watch here.
Authority or fatigue? Or well, it depends on the perspective that you're looking at. Authority in a sense that the government itself, the Capitol Hill, will start to push back on his directives a bit more, or
Yeah, like
generally speaking, that they're always watered. They end up being watered down.
Yeah, I think they'll start to push back more like this. Like I remember when he was first came in here again, like literally everyone was just caving to him. Anything he said, oh yes, he's the best,
Yeah.
go along with it. Oh yes, yes, yes. And we're starting to see a pushback on that. So I think those 2 points there, if they don't go in his favor, I think that could intensify this case a little bit. And especially with midterm elections coming up, I think that runs a pretty hot point.
Yeah, good point to make. Okay, we'll wrap up the show there on that note. Anything else that catches your eye, or what's your general demeanor? I mean, we've got RBNZ next week, but rate decision coming on Wednesday, so be aware of that for those who look at the Kiwi and all things Antipodean. Anything else catching your eye? We're past the midpoint of earnings season, I guess, and but it'll be interesting to see what the retailers, the big consumer brands, have to say. The Targets and the Walmarts and so forth will report, I think. So maybe some key data. Do you look at their figures and what they have to say?
I do a little bit, and I mainly look at that just to get another underlying trend sense for consumers, especially when you're looking at Walmart, Target, TJ Maxx, stuff like that. I think their demand fronts can give you a good, just another underlying layer of that kind of middle American spending patterns.
Yeah, good to know. Okay, my man. Well, listen, thanks again for your insight. Again, you're very thorough, and this is why we love you and our guests love you, because you kind of you get in there and you break things down, but you do it in a very easy way for us to sort of digest. So thank you very much, Sam.
Thanks. Yeah, it's fun. I love diving into this stuff. So.
Well, and we love having you on. Sam Cutler of 333 Capital. I'd like to thank anyone listening. This is going out on Friday, as I said. If you've missed the start of today's episode, you can listen back on X or YouTube, or find us on podcast platforms such as Spotify and Amazon Music, for example. Have a listen and see if it's something you like. If you do, subscribe and give us a like. So listen, have a lovely weekend, everyone, and we'll be back next week for more. Enjoy your weekends. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.